We discussed about trends earlier when going through the tenets of Dow theory, but we'll do in a bit more depth now. An uptrend is formed with a series of higher highs and higher lows. An uptrend line is a straight line connecting two or more low points through rising troughs of an up move to identify price support. The importance of trend line increases with every additional point it touches. An uptrend line, once established, acts as a support and indicates that net demand is increasing, which leads to rise in prices. As long as prices remain above the trend line, the uptrend is considered solid and intact. And a break below the uptrend line indicates that net demand has weakened and a change in trend could be imminent. Take a look at this index chart. An uptrend is in formation with a series of higher highs and higher lows. Now this is an uptrend line. Minimum 2 points are required to draw this trend line through troughs. When projected, it turns out to be a potential support line. See, with every additional point it touches, the importance increases. The importance here is not simply to define how strong this current trend is, but also when the same doesn't hold. When the time comes, the break of this very trend line will signal danger ahead. No doubt, as long as price remains above this trend line, the trend line is solid and intact. But a break below will be indicative that net demand has weakened. See how the price fails to hold trend line later on. Price takes out this trend line over here and eventually leads to a severe correction. Now we have GBP USD here. This pair has been observing a decent uptrend. The pair has been bouncing off this trend line, but see how the pair eventually breaks the trend line, and that too with a gap. It's a breakaway gap and a very bearish signal. Now we will discuss gaps later on, but see how momentum shifts on the break of this very trend line.